Anti-correlation and zero DT. We did a piece on anti-correlation on Friday, which was longer duration. And I thought it was really interesting. We got a ton of feedback. So we're going to take it up another notch and we're going to take anti-correlation to the zero DT. Does anti-correlation really matter with respect to zero DT trades? Does the VIX matter when it relates to the S&Ps with respect to zero DT trades? Let's take a look. So the market and volatility are generally anti-correlated. When one rises, the other falls, right? The market's falling a little bit today, and the VIX futures are falling a little bit today.
So unchanged right now. Yes.
So right now, we got a problem. Houston, we got a problem. We're in that 20% range.
Yes, so it's a muted move.
While the effect is strong, it's not absolute. In practice, all four combinations for SPY and VIX rising and falling are possible. Every market open is an exciting time for the zero DT traders as they try and determine the best position to take or adjust. How have short premium zero DT positions fared based on overnight moves in the SPY and the VIX?
Is that a question?
That's a question.
Without a volatility component to it? Oof, without a volatility component to it. Slight winner with big outlier moves.
How have short premium zero DT positions fared based on overnight moves in the SPX and the VIX? Let's take a look. And then we're going to look at them if they're correlated or not. 18 months worth of data. We're doing zero DT strangles. We can buy the wings. You'll see it here. You can just reduce the P&L by $10 if you're buying wings. All trades were close to 25% of max profit or held to the end of the day if you didn't have any profits. We contrasted the overall performance based on directions of the preceding night's move in the SPY and the VIX, and all trades were assumed to be exercised at mid-price. So last night, for example, was pretty flattish. You know, the S&Ps didn't really move, and the SPY and the VIX were pretty flat overnight, so it would be hard to say. But sometimes most of the time you get decent sized moves overnight. Let's go next slide. First, we looked at 378 occurrences over the last 18 months. And we determined that 35 delta strangles, 25 delta strangles, and 15 delta strangles worked no matter what happened. But daily P&Ls, obviously the bigger ones worked better. And the CVAR is like, what's your worst case? They're all kind of in the same ballpark. So the zero DTs have generally been working as a strategy if you take them off at 25% of max profit, right? We're kind of more around that middle column, that 25 delta. Here, we're going to look at the SPX down and the VIX up, because remember, they're inversely correlated, right? So there's 137 occurrences of SPX down, VIX up out of 380. That's how it shows you how kind of strong the market's been. When the SPX is down and the VIX is up, which is fairly normal, your win rate is across the board super high. Your daily P&L, super good. And your CVAR actually better than just on all the other occurrences. So why do you think that is? Why the number is so good for SPX down, VIX up? Because you're selling into VIX strength?
Into the one day, I would imagine.
Yeah, I think so too. I think because usually they rally. That's what I think. This is the SPX up, VIX down. There are 92 occurrences here. And the reason that this is interesting, first of all, I'm surprised by there's only 92 occurrences. And the second one with this is the win rates are a little bit lower. Not significantly lower, the win rates are lower. But what's interesting here is that the daily P&L on all of these is down, is a negative number. What they're basically saying is when the VIX is up, do the 0 days. When the VIX is down, don't touch them.
Right, or when volatility is low.
When the SPX is up and the VIX is down, this is my argument for the VIX one day, same exact thing. This is the whole freaking argument, because when you're doing the VIX one day, it doesn't make any sense when volatility is low. It just doesn't work. VIX up, SPX up. Surprising, a lot of occurrences this, VIX up, SPX up. When the VIX is up, you make money. What's so interesting about this study is that VIX up, you make money. VIX down, overnight, you lose money. The SPX doesn't really matter. It's down, VIX down. This one, there's only 19 occurrences. And this is the one that threw me off this slide, because the SPX down, VIX down, the win rate was 100% in all 18 occurrences. And the average P&L was huge. Seems weird to me how much different it is. So basically, premium came in on a down move. No CVAR because there's no losers. Over the past 18 months, selling zero DT premium was generally successful when the VIX fell overnight and the S rose. Overnight down moves in SPX accompanied contracting VIX very rarely, about once a month. Trades on days following those were extremely successful, but the sample size is too small to draw conclusions. The efficient market hypothesis tells us not to put too much weight into this recent chart action while making our trading decisions, but for highly active zero DT option sellers looking for overnight rising VIX, regardless of SPX movements, looks like a good place to start.
So I don't know, what's your takeaway from this?
Sell into strength.
In volatility.
Yes, sell into volatility strength.